JBlog, July 19th, 2010. Starting out by looking at a weekly chart of the New York Composite. Um, and this is, of course, a big picture view. The important part here is the 1030 crossover. That's the exponential moving average, which, as you can see, doesn't cross very often, and when it does, it usually stays on the side where it crossed. Now I'm looking at these last few weeks and I'm comparing that basically what happened back in 2008. September, October is usually a nasty time for the stock market, and this could very well happen this year again. We have lower highs, we have lower lows. It could very well be that there's simply going to be another capitulation move happening in October, November. Um, which would be unusual for the election, the midterm election, but it can certainly happen. No question about that. Daily, we had, of course, another run up, and all the bulls were all happy. And then we had the big down day on Friday. Very unusual. But these 2 days previous were basically down days as well, except for in the last hour, in the last half an hour, sudden volume comes in from Wall Street. Blatant manipulation for all I'm concerned. But on Friday those failed. It is surprising that that actually failed on Friday. That the bulls didn't try harder to make this red bar go away. Today we had a pretty pathetic attempt at regaining some of that, but it didn't hold. More pronounced actually in the S&P 500. More of a swing up down here. It was caught towards the end of the day again as usual. Interesting stories today. One of the ones that I'm following, simply because I am short Apple. Apple did was down $10 at one point and then rallied towards the end of the day quite strongly, but still finished definitely on the negative side of things. It was a downside violation here. This chart basically is pretty ugly. It should pay off, but let's see. What I find most interesting about this is that this general area here is when Wall Street suddenly recommended Apple as the buy. They wanted people to buy Apple options, Apple stocks. It's wonderful. It's going to go to 375, and poof, there it drops. It is very typical, very interesting. Um, Other interesting things that happened. Goldman Sachs, of course, had a settlement, and what's most interesting about this settlement is that it actually happened late on Thursday last week. That was the third week of the month, therefore option expiry. To have settlement this close to option expiry, and then of course the initial announcement that the SEC was going to sue Goldman Sachs also happened on the third Friday of the month. Again, option expiry. How can you make a pronouncement like that on an important day like that? Again, some people, if you had advanced knowledge of something like this happen precisely on that day or close to that day, you can make a lot of money in a very short time period. It is very interesting timing on the side of the SEC, that's for sure. Core sectors, the one that I'm looking at is the consumer discretionary, which of course confused me for a very long time because I saw this run up here and I saw consumer that was basically broke, and yet consumer discretionaries went up like crazy. Since then, consumer discretionaries have dropped, which is more in line with the way I look at the economy. Another stock along the same lines that I am short is SPG, Simon Properties, which is one of the biggest managers of shopping malls. And of course, as soon as the consumer segment is hit, this will be a stock that will be hit Actually, that's my contention. So anyways, I'm short that stock. I'm short that stock ever since back here, and I'm just sitting on it, and waiting, biding my time. Because if anything is going down, this one is going down. It's got a horrendous debt to equity ratio. The price per earnings is ridiculously high. That's just, I don't see any fundamental reasons why this stock should go anywhere. That's my take. That's why I'm short this one. Um, and yeah. What else do I have? Some stories that I'm following. Germans are showing no inclination to give up on the euro. So anybody who's betting on the euro falling apart, not quite yet. Maybe a few countries will be tossed out, but I think Germany will continue keeping the euro together simply because it is cheaper for them to do that and bail out just about any European country than to have another unrest slash war happening in Europe anywhere. Germans are willing to pay for peace, which is nice to see. I quite like that. What else do we have here? The Fed, of course, came out saying they see slower growth. Everyone sees slower growth. The only one who doesn't see slower growth is Wall Street. Wall Street's still up. I don't know where they live, but they're certainly not on the same planet as me. A story on small investors fleeing stocks. No surprise, we're talking about a population here that is aging. Baby boomers going into retirement, being close to retirement. They don't want to gamble on another market that is completely overvalued when there's no fundamentals. They no longer have time to bet. Um, they need a sure thing, and even if it doesn't pay a lot of interest right now, they are paying. They are simply buying money markets, as in GICs and T-bills and such things. Anything that pays a little bit of interest, they are no longer willing to gamble, and this is Wall Street biggest problem. They drove up this market from down in the depth where it was starting to become reasonably priced all the way up to here where it is ridiculously overpriced, and now they're looking for buyers, and there's no buyers out there, so they're in trouble, big trouble. Here's an interesting thing. China came up with its own rating agency. It doesn't want to put up with the S&P or the Finch people anymore. It came up with its own rating agency of countries which are stable and AAA, and it is quite interesting what it came up with Norway actually leading the way. Norway, Denmark, Luxembourg, and Switzerland, and some of the other countries, United States, Japan, Britain, France, Belgium, being close to the bottom, not really that surprising. Here's a New York Times article that the rich are no longer spending as much money as they used to, and they account for a large part of the economy, the shopping economy. They too are cutting back. Here's another article that was interesting, Wall Street Journal, about that once again companies are lending to people who cannot possibly pay back that money. The same thing as in 2007. Once again, we're in a bubble. Here's an interesting article that I was reading in Le Café American. Um, Sorry about the accent. Anyways, it talks about how the mortgage market has dropped, how the real estate market has lost $7 trillion, yet the mortgage market itself only has lost $270 billion, and there's a mismatch of basically six and a bit $1 trillion that have yet to be written off. Big problems on on the side of the banks. Obviously, we have more bad news coming. So that's all I have. It's short today, but those are the stories I'm following. I see nothing that makes me want to buy anything here, with maybe the exception of uranium long term, but else than that. Have a good week next week, and all the best. Good luck.